when do you know you're kind of the right fit for management consulting versus going straight to like a startup out of college, you think?
Yeah, I think
Like,
someone who probably came from a more structured environment, whether that be in their high school or their university level settings, or the types of clubs or organizations they joined, where they kind of like to be part of something that is established already, and that there was, let's call it best practices or ways that things happen in this organization or this university or this structure you're in. If you prefer that and you learn that way, then consulting would be awesome. Great experience, great way to start a career probably. If you prefer you're the kind of person who doesn't really like listening to people maybe, or, when you're playing a board game, you sort of figure it out yourself, or you.
Hey everyone, welcome back to the Ignite podcast. Today, we're delighted to have Vince Hsieh on the program. He is the partner at Cypress Growth Capital, been in entrepreneurship, startups, and venture capital for a long time. Vince, welcome to the program.
Thanks, Brian. Thanks for having me. Looking forward to talking.
Yeah, so would love to get an intro from you for the audience.
Yeah, Brian, would love to do that. So I'm Vince Hsieh, originally born and raised in California. Spent most of my early career in management consulting on the corporate restructuring side, both Arthur Andersen, back before when it still existed before Enron, at Arthur Andersen, and then Alvarez and Marsal in their corporate restructuring practices, working with private equity-backed distressed companies. They would hire, for instance, my boss to be the interim CEO for a period of time to kind of turn around their operations, their business in general, their financials. This is great introduction, early career to lots of different facets of business and how to make them better. Did that for about 7 or 8 years on the management consulting side. Then spent 16 years as an entrepreneur operator, 2 different industrial IoT software as a service startups, both of which eventually we exited to private equity. The first one sort of involved in the RFID and software space, selling to industrial construction. The second one, GPS and software, selling initially to oil and gas, and then eventually other tangential kind of industrial industries like agriculture, mining, construction, things like that. Like I said earlier, both exited private equity. In both cases, sort of at various points in time of the evolution of the company that we could talk about more later, sort of focused on things like sales and marketing, customer operations and operations in general, and of course like finance and HR and legal, all the aspects of sort of the commercial side or the running of a business from kind of startup to eventual exit to private equity. Did that for about 16 years. Then a couple of years ago, joined Cypress Growth Capital, Dallas-based investment firm here. That was actually the first institutional investor in that second startup, GeoForce. So I obviously had known them for about a decade as a portfolio company, working with them closely on our growth and eventual capital strategy and exit strategies. So knew them pretty well for a while. Joined as an investment partner just under 2 years ago here in Dallas.
Very cool journey. Thinking back to coming out of your undergrad and going into consulting, would you, talking to a similar aged person now, young person, would you recommend they go into consulting, or would you recommend they go the entrepreneurship route? You've kind of done both.
Yeah, so it's funny you said that. I've got 3 kind of teenage age kids, one of whom's about to, hopefully go to college soon, and is kind of asking some of the similar questions at a much earlier age than I was asking when I was his age, of course, just being exposed to obviously my career and growing up with me, obviously. So I would say, it depends on the person. Like that's a kind of cop-out answer, obviously, but I think there's benefits to both. I think starting at management consulting at a big firm, for those that don't know, like Arthur Andersen was a probably 85,000 person firm in its heyday. That went out of business after the Enron incident in the early 2000s.
It's still around in forms, right? It kind of got sliced up and rebranded,
rebranded or came back as like a tax firm, like maybe a couple of years ago.
I think it's Accenture, right? Isn't Accenture?
Well, Accenture was the consulting firm that split out much earlier. A totally different story there, but Accenture's been around forever, and that was a spinoff of Arthur Andersen as a consulting practice. This was Arthur Andersen's kind of separate practice in corporate structure that eventually went out. The whole audit and tax firm went out of business. But either way, the point is that being at a big management consulting firm where you start with like 10 or 15 peers, we're all bright, young, hungry, kind of that almost like I was in a fraternity, almost like a fraternity pledge class that comes in together, becomes your best friends, you grow up together. They have formal training programs. They send you away for a few weeks to a bunch of people around the world to get formally trained on presentation skills, Excel modeling skills, communication skills, and analytical skills. Kind of a very formal process for training, very formal process for doing the work they do.
Yeah.
It's a great way to start a career, I think. On the other side, I think having been an entrepreneur for 16 years, there's really no better way to learn certain things than honestly just doing it. Sort of the idea of like if you throw someone into the water through survival skills alone, they'll kind of sort of figure out how to paddle and get to shore or whatever.
Yeah.
And there's no better way to learn lots of different facets of business than sort of the startup world where everybody has to do everything and everyone's got to figure it out quickly or the company won't survive. So I think there's benefits to both. And I think I was privileged to have done both relatively early in my career, both consulting and entrepreneurship. I think it just sort of depends on the personality of the person. Some people learn better through sort of more formal processes or mentorship and things like that. Yeah. And some people learn better by just doing. So I don't think there's any right answer. Just sort of depends on the situation and your personality, how you want to do it.
Yeah, I love that. So kind of digging into that a bit, like when do you know you're kind of the right fit for management consulting versus going straight to like a startup at a college, you think?
Yeah, I think like, someone who probably came from a more structured environment, whether that be in their high school or their university level settings, or the types of clubs or organizations they joined, where they're the kind that like to be part of something that is established already, and that there was let's call it best practices or ways that things happen in this organization or this university or this structure you're in. If you prefer that and you learn that way, then consulting would be awesome. Great experience, great way to start a career probably. If you prefer sort of, you're the kind of person who doesn't really like, listening to people maybe, or, when you're playing a board game, you just sort of figure it out yourself, or you buy some furniture or buy something, you just want to assemble it yourself and sort of figure it out as you go and use the tools you have in front of you. Maybe entrepreneurship is better. And I would say this though, looking back, I would not advise that anybody sort of join a startup that's their first startup for the founders. Maybe join one that's like 2 or 3 startups down the road so they learn from some of their previous mistakes. And make it a better experience. And I would say that even if you want to go the entrepreneurship route, maybe you first work as like, employee 10 or employee 20 or whatever at a startup and learn that way, which is a great learning experience in itself. Before you take the leap and become employee 1 or employee 2 yourself. Just learn from them in that environment, but maybe not as the one with the neck on the line, so to speak.
Yeah, I like that. And how was that transition for you coming out of management consulting? What was that story like?
I don't think I would say I wanted to be an entrepreneur my whole life. Like there's people who could tell you the stories of how they had a lemonade stand when they were 5 years old or whatever. Right. I definitely did entrepreneurial-like things, like working when I was 12 years old or finding ways to make money at school, things like that. But never that I think, okay, I want to become an entrepreneur for the rest of my life or anything. But I think what sparked it for me was having worked in consulting for so long. And if you go back to what I was talking about earlier, it was corporate restructuring type work where the companies were struggling or in distress. These are big companies, well-known names and brands and companies, but they're struggling for whatever reason. And our job is to sort of take them from, let's call it negative to zero or negative to slightly positive in terms of, let's call it financial performance or just performance in general. And you learn a ton that way about working under pressure, about what works and doesn't work in businesses, what the kind of critical drivers of success for a company could be. And I sort of just wanted to say, hey, well, it's fun going from negative 100 to zero. What about going from 0 to 100? You could apply some of the same skill sets of being resource constrained and time pressure and all that, but apply it maybe on the more fun or the offense side versus the defense side, going from 0 to 100. And what better way to do that than either working with entrepreneurs or being an entrepreneur or working in growth companies. Right. And so that's sort of what sparked the idea. I was in business school taking some classes on actually RFID in this case in our operations class, and basically made some pretty good friends in school at Duke, led to kind of Atlas and Geoforce, the work there. But that sort of was sparked the idea that was sort of like wanting to do something using some of the skill sets I had learned before, both in college and all that, but also in business school and consulting jobs, but applying it towards something maybe more fun going forward, growing an enterprise from, in this case, scratch.
Yeah, so that's interesting. So both Atlas and Geoforce were pretty early when you joined?
Atlas was something that I co-founded with someone from business school.
Wow.
And then Geoforce, one of our other classmates, started it. I helped him with the initial fundraising business plan stuff while I was still at Atlas before we had exited, and then joined pretty shortly thereafter in the early stages, like 3 or 4 employees at Geoforce at the time.
Wow.
So yeah, that was fun journeys, but most importantly was with 2 of my best friends in the world, I would say, that I met in business school at the time.
Yeah, that's an interesting kind of connect to venture capital. How important do you think it is to have working experience or friendships or common ground, like going to grad school together when you start a startup?
Starting a startup become an investment, part of an investment team, whatever, all this part of a sports team, grow up playing sports, all that sports team, whether it be military, sports team, entrepreneurship. It's all the same common thread. You have to have a degree of camaraderie and trust in your partners or whoever you're working with at the time. And there's no better way to develop that than having spent time together before. You're never going to really gauge that truly in like even a multi-stage, interview process or anything like that, or arranged marriage of some sort. You're going to have to learn that just being in the trenches together, having, been in class together, being, out to events together, had meals together, spend time with each other's families. Having that relationship previously, I think certainly helps vet whether or not you can work together. It's not foolproof, of course, but certainly helps, I think, to answer your question. I think it definitely gives you that level of communication, judgment, skill, trust factor I mentioned earlier that leads to success for sure.
Yeah. And so walk us through that experience, like kind of, how much did you kind of grow those two companies? Why did you exit Atlas and join GeoForce, all that stuff?
Yeah, so I think in terms of what we did there, I think I hinted at some of this earlier in the intro here. Starting from nothing and growing to, something much bigger than that. And, like I mentioned earlier, eventual private equity exits. Quite a long journey, quite a tiring journey, but quite a great learning experience and also a lot of fun all in once. Like I'm also, a parent to 3 teenagers. It sort of mirrors quite a bit the teenage journey of going from babies and diapers to toddlers to, all the way to teenage level. Right. And so I think that the journey itself, if you don't appreciate the journey, then you're never going to get to the end because you're going to find so many different opportunities to quit, so many opportunities where it's hard or difficult, and it'll be easier to go do something else, so to speak. So if you don't appreciate what I just described as the ups and downs, the ebbs and flows and all that of being on this journey, you're never going to get to the finish line. You're not going to have the resilience and the wherewithal and the stick-to-itiveness, if you will, to get to the finish line. So I think this is going back to your earlier question, having the partner makes a difference. So like you're jumping off a cliff, but he's hold someone's hand when you're jumping, someone who's hopefully complementary to you in skills and mindset and everything to get there. I would say that journey was probably the best part of my professional life so far was working on these, again, to my earlier point with 2 of my best friends in the world. I would say that the people we met along the way, the people we hired, and unfortunately, along the way fired as well, sometimes for legitimate reasons, sometimes just because we're growing as a company and the company evolves and you need different types of people. They still are some of my best friends too. The people that worked with us on the journey that we hired and everything along the way. I would also say that the experience is one that is only better because I had the partners, but also because I had the experience before to ground me in certain mindsets and skill sets and business acumen and things that helped you succeed at this. I think going back to your earlier question, I couldn't imagine trying to do that when I was 22 years old or something. But being like 30 years old when it started, with Atlas, for instance, was much, much more manageable and doable.
Wow, that's amazing. So what is Cypress Growth Capital and what are you guys focusing on?
So Cypress, like I mentioned earlier, Cypress was the first institutional investor in the second company I described earlier. Cypress is based here in Dallas. All of us, like me, are all former entrepreneurs and operators, people with deep experience in management consulting, in startups that were successful, startups that were not successful, operating companies at different levels across different functions. All of us had that experience before joining Cypress, at least on the partner level here. What we do is we invest in emerging growth software and tech-enabled services, tech-type companies that are primarily kind of between, call it 3 million to 15, 20 million of revenue at the time we invest. They're generally kind of bootstrapped, founder-led, very capital-efficient companies located in the tier 2 cities, as they call them. They're not in Silicon Valley, New York, or Boston. Like we're invested heavily, obviously, in Texas, where we're based, but also Colorado and the Southeast and the Midwest, places like that.
Yeah.
You can find, again, founder-led companies. They're doing something pretty good in the B2B space, software space, probably usually, but also pretty capital efficient. They know how to stretch a dollar. They've been profitable before because they're generally bootstrapped or very lightly funded from maybe friends and family, angel or seed. They're now at an inflection point of growth. They've gotten to 5-10 million of revenue in general.
Yep.
They've obviously got some product market fit. They've got beginnings of a sales team, maybe a marketing team. They have certainly a product engineering team, but maybe not product management yet, things like that. They're at an inflection point. They just landed a huge contract they need to deploy. Or they know they can grow so much more using the same playbook in a different geography or adding certain product features, whatever it might be. They have certain vectors of growth they know they can get to. They just need a few $1 million of capital to help them get there.
Mm-hmm.
And then Cypress comes in at that time and invest, $1 to $5 million of something called royalty-based capital that we can talk about in a second.
Yeah.
It helps inject them with enough money to kind of use those dimensions and get to a much bigger revenue number. And therefore, it's also a bridge to some later transaction, either a growth equity transaction, a private equity recap like my two companies did, or a sale of the company to a strategic, like a few of our companies have done fairly recently. We bridge them to that by helping them have that few $1,000,000 of capital, our counsel as former operators and entrepreneurs, and obviously their hard work and dedication gets them from, 5, 10 million to 10, 20, 30 million revenue. And then a deal a few years down the road from us, that's at better terms, better valuation, all that. So we're allowing them to use a non-dilutive form of capital to bridge there, but enough capital, 1 to 5 million, to be meaningful, impactful, to drive growth on those dimensions I talked about.
Wow, so much interesting stuff to unpack there. Let's start with royalty-based financing for folks that don't know what that is. What is it? Why would a founder use it versus like a traditional priced round?
Yeah. So we combine what we think is, again, as former entrepreneurs and operators, we've been on the other side. We've raised capital. We know what it's like to be diluted. We know what it's like to have a board member, all that kind of stuff. It's a great combination or a hybrid of the best of equity and the best of debt, we call it. It's like debt because it sits on your balance sheet technically. You make monthly payments technically, and it's non-dilutive like debt. But it's not like debt because, first of all, usually companies of this scale can't generally qualify for debt at this scale of a few $1,000,000 unless it's obviously personally guaranteed, comes with pretty restrictive covenants around liquidity, EBITDA, different things like that, that for an entrepreneur that's growing the company has its natural ebbs and flows where it's hard to forecast, 6 months in advance, much to 6 days in advance sometimes. It's hard to meet those covenants sometimes. Those covenants can be restrictive and drive, secondary or drive decisions that are not optimal, right?
Right.
And so it's not like debt because there's no personal guarantee like debt would have. There's also no covenants at all. And there's also technically no fixed payments. The payments to Cypress currently are a percentage of cash collected every month. So typical debt has fixed interest payments. Every month you're paying X dollars no matter what. In this case, if your cash is higher or lower in terms of collections in a month, you pay us more or less. So sort of fluctuating cash payments. And unlike debt, there's also no end date. There's no fixed end date, at least. Debt, usually in a few years, you owe them a balloon payment or whatever, and you got to make all your decisions around the business and exit around that timeline. Whereas here, you just keep paying us this monthly royalty until a predetermined multiple or investment amounts hit and you end the obligation. And so it's much more flexible than debt. It's way more like equity in the sense that equity is very open-ended. Equity has no fixed end date, and equity generally comes with people like us who can, potentially support you on the journey with what we call more than capital in terms of support and guidance, sound advice on various things and growing the company. But unlike equity, which has an uncapped upside, the royalty structure has a capped upside in the sense that, I mentioned earlier, paying us this monthly royalty that's a small percentage of your cash collected every month. You keep paying that cap, that royalty until you've hit this predetermined cap on the amount you took, which starts at generally like 1.5x the money. It can grow over time to 2x in a few years or something. So that compares much more favorably to equity if you're growing rapidly. So if you're going to grow your company rapidly in that time, your equity might have 5 to 10x if you 5 to 10x your revenue. And this costs you, let's call it 2x. So much cheaper than equity if you're growing quite a bit, but much less restrictive than debt. So kind of a good hybrid solution for companies that are looking for a few $1,000,000 to accelerate growth on certain dimensions and want to use it as a bridge to some eventual transaction of a larger scale, either on the equity side or sale of the company.
That's interesting. So there's a card cap on the other side. You're saying, hey, we're going to cap this at, call it 2x. So,
Sure.
And that might take like a certain number of years to reach.
The faster you grow, the faster you get there, so to speak. And the cap climbs over time. Like it doesn't start somewhere and goes up over time. It's variable depending on certain metrics and things like that. But it grows generally over time. So the faster you pay it back, the lower the cap is. The longer it takes you to pay it back, the higher the cap is. But you can imagine a scenario where if you're growing really rapidly, you pay it off in a few years, 5 years, 6 years, 7 years. But the point is it could take you 10 years, take you 12 years. You grow slower. But unlike debt, there's no end date, right? Just it goes until you're done paying it. That said, the vast majority of the time, almost every time, the companies take our money, take our capital, they take our counsel, and again, their own hard work and dedication, everything they're doing, they grow tremendously in the time that we're invested, and so much so that they're attractive in a few years, usually 2 to 4 years, to some sort of growth equity, private equity, or strategic sale of the company. Yeah. And usually what happens is in like 2 to 4 years, they exit us early to some kind of event. And so when they exit us early, they'll say, okay, well, I owe you, let's just say 2x in 4 years. So they owe us 2x the money, but they've already paid us a few $100,000 in royalties. So subtract that few $100,000 from what they owe us, and that's what they owe us. And then they're done with the obligation. And they've saved not only the dilution that I talked about earlier, you know, equity might climb 5 to 10x, is, you know, was 2x or whatever.
Yeah.
But also all the other elements that come with equity at an early stage that includes like control provisions, blocking rights, board seats, you know, things that like that could, you know, potentially hamstring how you run your business, which are probably appropriate for some companies at a later time, but at this earlier stage, you know, are sort of restricted for a company. So it allows them to not have complete control of the company for a longer period of time. We call it like almost an extension cord. You know, you're powered by yourself now. You're getting an extension cord to stay self-powered to get to the eventual larger transaction down the road.
So it's like an unconvertible note, kind of secured by a revenue-based variance or something.
Essentially, yeah, it's along those lines. Yes.
Yeah, that's interesting. And is there a floor multiple and then a ceiling multiple, and that's time-based?
It's based on time. It's based on the conditions of the company and all that. But it generally starts at 1.5x, and it kind of climbs from there to, you know, again, 2x in a few years for most companies.
Interesting. Okay. And then from the LP perspective, I'm putting my LP cap on. Why would I invest in Cypress Growth Capital versus any other typical growth stage venture fund?
So I would start that by saying that, and just to tie this off, we just finished deploying our 4th fund in 14 years and just raised our 5th fund and actually start our 5th fund tomorrow morning, May 1st.
Oh, wow.
So, you know, this is 4 funds in, 56 investments in, 57 as of next month. You know, the history there.
Yeah, that's a lot.
It's a unique situation where, and to be full disclosure, I was a portfolio company. I was an LP, and then now I'm a GP in Cypress. So kind of every possible side of Cypress you can have. I think it's a unique thing where it's sort of a good win for everybody, the entrepreneur, the GP, and the LP.
Yeah.
So from the entrepreneur's perspective, they cap their upside, or they cap their, not upside, their cost.
Right.
But the trade-off, of course, is they're paying a royalty every month, so they have a little bit of a floor of a downside. Like with equity, you could pay nothing, and never pay anything if you fail, say.
But you also gave up 10 or 20% of your company someday.
You might give up 10 or 20%. You might give up 10x the money. If you 10x the company, you give up 10x the multiple on the revenue. Let's raise $1 million, cost you $10 million.
Right.
That's the entrepreneur says. This is good for the entrepreneur because it's sort of like it's a hedge for you. Like you're capping your upside, but also have a little bit of downside. But if you're bullish on your company, it's great. You can grow. That's the entrepreneur perspective.
Which most entrepreneurs are. Otherwise, they would quit what they're doing. And
if you're not bullish, why are you starting a company? Why are you doing it?
Yeah.
If you don't think you can 10x your business, then why would you do this? So people who self-select out, is like if they don't think they can 10x their business in the next few years, then they're like, oh, this seems expensive. Well, then they just don't do it. You know what I mean?
Right.
But if you think you're going to 10x your business, or you think your LTV CAC is pretty high, much higher than the cost of our capital, then you should take the money and go do it.
Yeah.
That's the entrepreneur perspective. So your question on the LP perspective is sort of the other side of the coin here, is that we're sort of locking in a pretty narrow band of return across 4 funds now. Because we're getting this monthly royalty from companies starting on day one.
Your IRR is a little higher because of that.
IRR is higher, and also just we have a capped upside. We're never going to get a 10x or 5x, but we're sort of always
the downside too.
Yeah, our downside is completely floored. Because the royalties every month for every company. So it sort of gives you, like we call it in our fundraising deck, bunch of singles and doubles from a return perspective, but no strikeouts and no home runs across any of the companies, across any of the funds. So our return our net IRR, net multiple on all 4 funds, very narrow, very similar and very narrow, very consistent.
Behaves like a debt fund, but like at a little higher interest rate, I would imagine.
Yeah, the IRRs are higher than what you might get in a typical debt fund, much higher. Or top decile across all the first 3 funds that have kind of been closer to realize.
Yeah.
Top decile against private debt funds, top quartile against private equity funds as well.
Right.
Across, again, the first 3
Which if you can consistently do that, I mean, a lot of LPs like that consistency, right?
Exactly. Almost no standard deviation, because no matter the company, and this is going to sound terrible to say this, a lot of our companies are home runs. Our average company in the time we invest, 10x is their equity in the time we're invested. So we've got a lot of home runs in our portfolio, but our returns capped at, let's call it a double, right?
Yeah.
But we also don't ever get any strikeouts, because even if I say this wrongly, but if they don't perform that well, just grow slowly, we're still getting our royalty return and getting our 2x back over time.
Yeah.
Just might be getting a little bit slower.
Yeah.
You know what I mean? So the LPs love it for that consistency. It's not, someone's single like investment.
They don't have to wait, like in a typical venture fund. I mean, you're drawing down the capital over, call it 3 years, 4 years. And then you're probably not getting any distributions till, years 5, 6, 7, and sometimes 10 to 12.
Yeah, they're getting a return almost immediately because we're getting a royalty almost immediately.
Yeah.
Like we again, our fund starts on May 1st. We make our first investment. I'm going to make this up for now. Let's say in June. Yeah. Well, then starting in July, we're getting royalties, and we're for the most part returning money to our LPs as well. Kind of that same thing. So to your point, you're getting capital return pretty quickly relative to like an equity fund where you wait till the tail end of the 10-year cycle to get anything back. So you're getting that back quicker. Your IRRs, very narrow band return. So it works for us. It works for the LPs. It works for the entrepreneurs, which I think is a great win. But again, it's like this hybrid strategy of like singles and doubles, no strikeouts and home runs. So LPs,
it's a nice little niche that you guys have. It's an interesting niche that I think it's quite innovative from a financing perspective, and a finance nerd like me, that worked on Wall Street and mortgage-backed securities, CFA, all that stuff. I'm like, ooh, this is interesting.
It's sort of if you look at it, like if you look at our chart, like it's a very high, like the comments from our LP meetings, like very narrow return band across the first three, nearly realized funds, and a very high, to your point, IRR. Top decile for debt, top quartile.
Well, and the variance, right, from a financial perspective, to go and say, hey, the standard deviation is not your typical venture firm, which, let's say the typical venture firm returns on average 20%, just for sake of argument. We talk about top decile, top quartile, but that variance on the return, that means the, two standard deviations might be from, 50, 60% on the high end IRR to like 0 on the low end.
Yep. And we will never get a 0. We can't even get a 0 on a deal because starting in month 1, they're paying us an individual deal, the royalties.
Right. What is that? And what is that percentage annualized, like on the $1 million or $5 million they raise? What is that typical?
Can you repeat the question?
Yeah. What's the kind of the annualized kind of debt payment that they make?
So it starts out, it's in the low single digits per month of cash collections.
Yeah.
So call it 1 to 5% is the range. Let's say it's 3%. So you can think about, if you're a $10 million business, let's say you're a $12 million business collecting $1 million a month,
right?
Just use round numbers. The monthly payment's $30,000. You know what I mean? 3% on a 12, and so
reasonable.
For a $6 million business would be like $15,000 a month. You know, something like that. So it's meant to be much lower than like a typical debt structure. A typical debt structure, interest and whether it's principal and interest or it's interest only,
much higher coupon rate,
per month, so to speak. Ours tends to be lower because we're really playing for that like royalty. The payoff when they have to exit in a few years.
Right.
Again, to my earlier point, almost all of them do not only one company's ever organically paid us off in 14 years.
That's the 3% over a very long period of time.
So you get paid a little bit, and then you get paid your 2x or whatever, total 2x.
Cap on the next year's equity round or whatever it is.
Yeah, exactly.
That's really interesting.
That's generally how it works. And so if you're modeling this against debt, if you're an entrepreneur, again, if they could even get debt at this stage, because these are much smaller companies usually, our monthly payments are lower, but then the balloon payment's gonna be higher, but it's gonna be a balloon payment tied to an exit that you chose, an exit date that you chose, not an exit date that the bank chose. You know what I mean?
Right. It's a lot more flexible in that way, right?
Way more flexible than debt, no covenants, no guarantee, no fixed payment.
Yeah. What's the longest maturity that you allow?
15 years.
Wow, so it can go 15 years. Wow. Yeah. That's insane. The
company's only 14 years old, so
nobody's ever gone 15.
Their longest is like 10 years.
Wow, that's amazing. And then let's talk about what a top decile, top quartile in equity looks like. Like what is the IRR that you see?
I think I'd rather not talk about that.
Not for Cypress, but if just what is a top decile IRR for debt funds, and what's a top quartile? I mean, people could probably go look it up, but
yeah, in general, like top decile debt funds, over the many years or so, is like north of 20% net IRR. Maybe a 1.8, 2.0 multiple.
Yeah,
I will say, without disclosing too much, that we're on the higher end of all that.
Right.
Across all our 3 funds. But for if you go look at PitchBook, to your point, and all the different publicly available databases, top decile debt is if you're going to round this off, north of 20, north of 2 on a multiple basis.
2 over what period of time? Because 20 would double every 3.5 years. Right.
Yeah, and there's also the concept when the money comes in and all that, and the royalties, right? But it's roughly that 5 to 7 year time frame.
Yeah, got it. And what about for on the venture capital side of things? What does a top quartile venture fund look like?
Top quartile, I would say, would be similar to the numbers I just quoted.
Okay, about 20. Okay.
Now quartile instead of decile because it's equity, right?
Equity.
But to your earlier point, equity is a much larger standard deviation,
right?
Across many dimensions.
That's really interesting. Well, it seems to be working out for you guys. So after you guys make the investment, like are you guys taking a board seat? How are you guys adding value? Like how deep do you get with these founders?
Yeah, so out of our royalty fund, no board seats, but we play very much an advisor or a sounding board role to our companies. All of us, like myself, former entrepreneurs, operators, have been in the seat, so to speak, before, working with them. On that side, kind of can empathize on a lot of things they're dealing with. I think one thing I've learned over the years is that, like, no matter what the company is, no matter what you're doing, all companies deal with very similar issues. Different stages of growth from like 0 to 5, 5 to 10, etc.
Yep. Yep.
So we're there very much as a sounding board, opt-in basis. We don't have any playbooks. We don't come in and say, here's our playbook. You must run marketing this way. You must run finance this way or whatever. We very much listen, work with them. We work with 56, soon to be 57 investments, 57 very different CEO profiles or founder profiles. Obviously some patterns here and there, but very different people. So we sort of take their guidance on how much and what they want to engage on. But when they want to engage, some of them we engage with on a very frequent basis, on a scheduled monthly basis, on especially the beginning. Some it's a little bit less because maybe they're a 5-time founder and just want like a sounding board for certain topics on an ad hoc basis. But either way, it always tends to be sort of a lot front loaded in the relationship, a little bit less in the middle, and then a lot more towards the end. One of our partners here calls it a barbell. A barbell in terms of the amount of time we spend with them. At the beginning, we invested a few $1,000,000. It's about how to deploy the capital. So we have like maybe sessions if they want it around go-to-market, around channel strategy, international diversification, some product-related topics, some like, let's call it, probably the biggest topic a lot of times is like people-related. I think I mentioned this earlier, like the people who got you here won't necessarily get you there.
Right.
Like learning, right. You got to I think I hinted at like having to like let some people go that maybe were integral to you at the beginning when you were a smaller company and were doing certain things. Had to have people who do everything, play utility positions in baseball. Yeah. Because as you get bigger, you got to have more specialized positions. Specialized functions of things. And so I think a lot of our time is spent sort of thinking through what that looks like.
That's always a challenge, right? For founders, because, you feel like you owe these people something, right? And and they feel like they're entitled a bit, I think, because they've been there for years and helping you, go 0 to 5 or 10 or whatever it is. But all of a sudden, like you said, it's a different game, right? Now we're not in the minor leagues anymore, or in the farm league, or use your favorite baseball analogy. Now we're in the pros. And,
I equate it to like Pee Wee. I don't know if you or anyone else on the listing has Pee Wee soccer. Like I used to coach 5-year-old soccer for my 3 kids. And Pee Wee soccer, everyone runs everywhere. Everyone's touching the ball. There's no position. But as you get older in soccer, baseball, whatever sport you want to talk about, you can't have the right fielder run and go catch the ball from the left fielder. The left fielder is going to catch the ball.
Yeah.
And so that's sort of the analogy with the growing team too. Is you go from Pee Wee soccer to like more organized positions and defense, offense, etc. And that's sort of a transition. And some people can make that transition, like just naturally, just because as the company's growing, they're growing as well.
Yeah.
But some people, they need to be hired over, and some people just need to be counseled out of the company. And that's, to your point, very difficult because my earlier point, they become like your family members if you're working this close with people for so long. You said they feel like you owe them something. You also feel like you owe them something as well. They did a lot to get you there, but I think over time I've learned that that's what compensation was for. That's what maybe stock options were for. And I've also had people that I let go in the past where they ended up finding a happier spot for them because like I'm going to use an example of like, I don't know, accounting. The bookkeeper who you use when you're 1 million, 5 million, when you started becoming international or needed to do more complicated GAAP accounting, couldn't scale to that level. But then when she or he found another job in another smaller company that was small and always going to be small, they were very happy there. You know what I mean? And that company was, a few million revenue, always going to stay a few million revenue. That person was happier there as the bookkeeper or office manager there. Whereas at a company, they need to go GAAP accounting, you need to go international. It's a much more difficult transition. You can hire professionals who can do that at scale. But they ended up being better in the new place, and we're better off as well. So it ends up being a win-win for everybody. It's almost not fair to anybody to string it along too much longer. But my point is that we spent a lot of time thinking through that concept, but also working with them to strategize and sounding board how to transition that, how to communicate it, how to structure the organization, from going from, let's call it bookkeeping to accounting to finance, go from like engineers who just do stuff and manage the product to having separate product management, having UI, UX, having things like customer support, doing customer support and account management, to having customer support and customer success or account management doing different functions, sales and marketing being different. Just the way you grow up as a company, kind of
you just specialize over time. I like that analogy of product and engineering and account, like just accounting alone. You start off, you have like the bookkeeper, and then by the time you get to a $50 million company, you have dozens of people working accounting doing all kinds of different things.
They have
So I like
AP
that.
people and AR people,
Yeah.
and you have people do AR from A to C and AR from D to F. Whatever. Like you get
Yeah.
more at a much
Yeah.
bigger degree, right? So
Right.
we sort of help coach them through what that looks like and strategize about it. Ultimately, we don't do anything. We're advisors. We help them. They have to make the decisions. They have to implement the decisions. They have to live with the decisions, of course. We're there to support them, any way we can. I kind of draw the analogy to like they're the dad or mom of the company. They're the ones in the business running it. Dad or mom has to change diapers, pay for braces, teach them how to drive, discipline them, everything. Then grow the company, grow the kid. And we're more like the uncle who we're uncle to lots of different companies, but we're not dad to any of them. We're not changing diapers. We're not paying for braces or whatever I said, but we're there to support them as a uncle could be a support to the dad.
I like that. Team Ignite's like the parent, and Cypress Growth Capital is like the college professor.
Yeah. We help support them that way. I think if you ask any of our entrepreneurs, they all say that the biggest differentiator for Cypress was just the relationship they had with us, both before the investment, during the investment, and also even after the investment in terms of the guidance we provide. I always thought when I was on the other side, we eventually, after Cypress, we did raise growth equity in private equity and sell to private equity. Cypress, though, was always, I thought, the most impartial and the best counselor and advisor we had. A couple of reasons. One, they had been operators and entrepreneurs before, so they kind of uniquely understood that, whereas our growth equity investors were, career finance people, let's call it.
Right.
Never necessarily ran the business in the business. They obviously knew a lot about businesses and how to grow them and all that, but never in the seat, so to speak. I think the second reason is that, whether or not you want to think it or not, I think to your question on the board and equity investors, even though I just got done saying can be kind of open-ended, they sort of have timelines they're trying to hit. They want to exit in X years, 5 years. They have fund cycles to think through all that stuff.
Right.
They also have a fiduciary duty as a board member to make certain decisions and think through certain things, right? Us as non-board members, and we have no skin in the game on when you exit. We can be a lot more impartial on kind of the counsel and things we think through.
Think about the long-term viability.
We can definitely think more like them because we didn't get into this too much, but like we kind of, from an LP perspective or GP perspective, we win either way. They either exit us very fast and we get a high IRR but a low multiple, or they exit us very slowly and we get a lower IRR but still really good IRR, but a much higher multiple.
Right.
You know what I mean? So we are indifferent. We are truly indifferent financially, let's call it, or from a math perspective, on if you want to exit us in 2 years or 10 years. I mean, obviously, there's a sweet spot that works, and for most companies, that's generally a few years. But we're truly indifferent on that. We've been entrepreneurs and operators as well, so we can genuinely give, I think, better, unbiased guidance and counsel, which is what I felt when I was on the entrepreneur side, versus like even an equity investor for entrepreneur sales. They do have timelines. They're going to do the best interest of the company. But if you're a board member, you're an equity investor, you have some other interests in line as well that aren't.
Sometimes they make the investment late in their fund cycle. And now it's kind of like, hey, it's been 5 years, 7 years. And they're like, hey, what about an exit? Like what are exit opportunities here? Because I need to get liquidity because, I'm on fund 3 or 4 and I need to go raise the next fund.
Yep.
And my LPs probably won't invest unless I get some DPI here.
Or like to your, on the flip side of that, sometimes they have blocking rights. And it could be that a deal that, I'm going to make up a multiple now, a deal at 3X might be great for the entrepreneur, for the early investors and all that, and for the employees. But for whatever reason, the equity investor wants to wait for 3.5X or whatever, something better than what they have now. And then they can block the deal and then they hold everyone, I don't want to say hostage, but sort of hold them hostage a little longer to get to the higher number that may or may not happen. So they take different levels of risk than maybe the entrepreneur might want to do. And so my point is, like Cypress, we don't have that type of dynamic because we're not equity investors out of the royalty fund.
Yeah.
And we are sort of indifferent, structurally, in terms of when they exit, earlier or later.
What are some common characteristics when you guys win investments and when you lose them? Like, why do founders turn you down, and why do they definitely sign up?
Yeah, so just to give you some numbers and perspective, right? In Fund 4 that we just finished, we talked to call 1,000 companies, and eventually invested in 16. So we have a pretty high bar for finding, selecting the right types of companies that fit within our profile.
Right. Yeah.
Bootstrap companies, capital efficient, generally kind of bootstrap. That means they're probably profitable or close to it, or have a path to it. Must have a solution in a rising tide market, all the kind of generic things like that. But probably most importantly, we're looking for really, 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 really good entrepreneurs and leadership teams that we think as former entrepreneurs, we can do a good job of picking. that have the mindset, the wherewithal, the resilience, the resourcefulness, the smarts, the ability to build a great team and inspire it around them, because it's not a single person sport, it's a team sport, clearly.
Yep.
We think we do a good job picking. We have to spend most of our time picking the really good entrepreneurs. Everything else will be good as long as they're good. You know what I mean? So that's the selection process on our side in terms of what kind of companies we're looking for in general. In terms of why they pick us, I think I hinted at some of this earlier. And you said you agree. Like if an entrepreneur is bullish, and they generally are, if they're bullish that their company's going to grow quite a bit, they just need a few $1,000,000 at this inflection point to help them get there either faster or de-risk getting there. Then it's a no-brainer for them. If they're dilution sensitive because they own 80% of the company or even 100% of the company, something like that. If they are very, very high conviction they're going to get there, if they just go and add this feature, or they're now in the West Coast, what if they just add the East Coast? Or if they just build out a marketing team, or they already have a small sales team, now they need professional sales leadership, or they have 5 salespeople, they need 10 salespeople, whatever it is. They know exactly what they have to do, and they know what the results will be because they know their metrics, they know their LTV, CAC, they know all that stuff. That's the kind of company we want to invest in. That's the company that will pick us. Sort of, we want them and they want us if that's the situation.
Yeah.
It's a win-win. If either is not true, then neither of us is going to want each other, It also tends to be people who don't want to raise $25 million right now in Silicon Valley or wherever. To my earlier point, they know how they're going to spend the money, and they know that $5 million will go really far in Nashville, in terms of engineering, in terms of everything they have to do, It tends to be people who are, generally speaking, weighing us against equity. Like when I chose Cypress back in 2011, 2012, our other term sheets at the time were all equity.
Mm-hmm.
We had kind of bootstrap friends and family to about $5-6 million in revenue.
Wow.
We're an inflection point of growth.
Yeah.
Knew we needed outside money to be able to fund hiring like a true head of sales, international expansion for our customers that were international, things like that. We knew we couldn't do that just with organic profits. We wanted to raise outside money. Our other options, the other 5 options, were all equity term sheets.
Yeah.
And with the one, Cypress, royalty-based financing. It's almost always they're comparing us to equity. And so to answer your question in terms of why they pick us, is because they're comparing us to an equity term sheet, and they don't want to do the things we talked about. They don't want to give up 10x if they 10x the business. They don't want to give up blocking rights and board seats and have someone have a hand on the steering wheel and a hand on the brake as well of the car. They want to have control of the car. You know what I mean?
Yeah.
And we give them that. We give them that control. We give them the non-dilution. We also give them the counsel if they want to opt into it. So that tends to be those people. They all tend to value they all do value the more than capital, because this is a pretty unique model, right?
Yeah.
It takes some time to understand for some of them. It's one where if you don't want our counsel, that's fine. Just pay us a royalty every month, you'll get there. But generally speaking, they're doing this because they actually want to work with us. They want to use us as a sounding board. They want to use us for whiteboard sessions to think through the things we talked about earlier on go-to-market and product. If they want that, then they want to work with us. If they don't want that, then they might go look for a passive equity investor or even a debt fund if they can get a form of debt, traditional debt.
Yeah, that's interesting. So they might take the equity, and in what cases will they go, you know what, I'm going to go with the equity, or I'm going to go with the debt?
So debt tends to be much larger companies that can actually get debt at this scale, because usually a $5 million company is not getting $5 million of debt from anybody else. I mean,
it's too much. Yeah.
So usually it's a larger entity, $20, $30 million in revenue, and they're at a scale where they can get debt. They probably wherever they get there. So usually they're picking debt only because they're too big for us. And if they're too big for us, if they're 20, 30 million in revenue, then their monthly royalty payments in our structure would be much higher as well, because they're paying a percentage of the cash collections. Yeah. And at a certain point, if you're paying us like $150,000 a month in royalty payments, that defeats the purpose of raising growth capital, because the money's going right back to the investor too quickly. You know what I mean? Yeah. So if they're too big, they might go the debt route. You know what I mean? Or if they only really needed $50,000 or $250,000, well, maybe they can get that through a personally guaranteed line of credit at their local community bank or the bank they have the personal checking account with, which is like the path I had, for instance. Just Wells Fargo would give us a line of credit on the debt side. Right. On the equity side is generally because they're trying to raise much more. Like they're trying to raise actually 10 million or 20 million. And we only can do up to 5 million for the reasons I talked about earlier. We don't want to give you too much royalty stuff and you have to pay me back too fast. The royalty payment's too high if the royalty investment's too high. And so they generally, they're trying to raise more than that. So they want to go that path. Or, this being sound a little self-serving, they're really actually just not as bullish as they think they are. Like they do the math and they think, well, I think my likely scenario is I'm going to 3x the business. So I'm going to 3x my equity or whatever. And this is going to cost me almost that much. So why don't I just do the equity thing, Whereas if they actually model it out and thought they were going to 5x or 10x, then this would become almost a no-brainer.
Right.
You know what I mean?
Yep.
So there's a little bit of a, maybe there's not truly there, they don't truly believe it, or there's more risk in the business than they think. And so they end up just going the equity route. Because the equity route could be free if you don't get certain numbers.
Yeah. Well, why don't we wrap up with a rapid fire?
Sure.
What is your favorite book on entrepreneurship?
So first of all, I would say, and I know it's not rapid fire, but the best way to learn entrepreneurship is actually just to do entrepreneurship. Like you learn by doing, like all the trial by fire, so to speak. But of all the books I read, I would say the one I like the most or that resonates for the longest with me has been the E-Myth. There's a lot of concepts, but I think the key one I remember learning from 15 years ago probably was you got to be working on the business, not in the business.
Yeah.
As the head of the entrepreneur, all that stuff.
Yeah, that's something I have to keep in mind running my little venture fund. What can I delegate, basically? What can I hire people to do? Do I need
what strategic decisions can only you make?
Yeah.
You yourself the proper time and space to go make that decision.
Yeah, absolutely. What's the most challenging decision you've made in your career?
It's the recent one from a couple years ago. You can tell by my background, I in consulting for 7-8 years and entrepreneurship for 16 years, kind of constantly doing and really focus intently on one thing. To make that transition, the investing side was both one of the toughest decisions, also one of the best decisions I made to make that transition to my early point from dad to uncle, so to speak.
Yeah, I love that. I recently made that transition myself, and it's awesome. What's one startup sector you're most excited about?
So the world's population is just growing, and the one common thing that all humans have is we all need to eat. We need food, nutrients, whatever. So not that we've invested in this sector yet, although we're getting close on a few of them. I think ag tech is pretty fascinating, something we probably should spend more time thinking about and working on, just because we do need to feed all these billions of people in the world.
Yeah, what's exciting there is like all the robotics and AI and computer vision that's being implemented. I'm seeing, studies where they implement robots that go through the fields and, they pick the strawberries just exactly when they're ripe and they yield and they do, fertilization and watering and all the plant care exactly as it needs, as if there's a human, just there all the time, right? That's what robots can bring to ag tech. It's pretty exciting.
Yeah, it's amazing what's happening there.
Yeah. A key skill every entrepreneur should have.
So this is not my insight here. Is obviously people have said variations of this for plenty of years now, I think. Is like you got to be really, 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 really stubborn on your vision and have like strong conviction on what you believe in. First of all, I've taken the lead to be an entrepreneur and to go do these things and do things and know things you can do. You got to be very stubborn on some of those things. You also have to be very, very flexible once new data or new information comes in that might change the decisions and all things like that. So I think having that combination of stubbornness and flexibility or adaptability is a key trait that entrepreneurs need.
Yeah, I love that. What's your go-to productivity hack?
Literally, I put everything on a to-do list. I have a personal to-do list and I have a work to-do list.
How do you like categorize or rank your to-do list? I'm curious because I have both as well.
So I use Gtask, Google Tasks. Yep. So that way I have it on my phone. If I gotta go pick up milk or something, or I gotta a perfect example, my son just got his driver's license. I gotta go call the insurance company today. The second I thought of that last night, I put it on my to-do list. So I don't forget to do it today. Call the insurance company to add him insurance. Right? But I use Gtask and I have 1, 2, 3. Very simple. 1, 2, 3. 1 is I do it today. 2 is do it as soon as possible. And 3 is do it when you have time.
Yeah.
And everything I put on my to-do list, personal and work, is a 1, 2, or 3.
I love that.
It's all in Google Tasks, and I can see it on my phone. I could change it on my phone. I could see it on my Gmail.
I do the same. I call them different, but my category 3 is getting really long.
I need to probably category 3 is like there's things on category 3 been there for 2 years. Like
exactly.
I'm supposed to write a certain blog. I haven't
exactly.
Half,
I actually moved all my blog ideas off to a separate Google Doc, and that's getting really long too because I'm not getting any time to write because I keep doing these podcasts, which I enjoy a lot more than writing, honestly. What's your biggest lesson learned from failure?
So I think this was a Bushism, like Bush 43, trust but verify. So on the entrepreneur side, I got burned too many times on financial reports, on engineering reports, or things that are quality assurance tests, things like that, where best intentions, people told you whatever, but until you go and actually verify or even drill in a little bit or even spot check certain things, you just don't know. And it goes back to your earlier point about the E-Myth and delegating and all that. You got the right balance of delegation includes trusting but verifying.
Yeah. I got to do that with some of my founders, actually. It's like, okay, interesting growth. Let me go look at your financials. This is great. How can people get in touch with you and Cypress Growth Capital if they're interested?
So Cypress Growth Capital, we're based at a campus called Old Parkland in Dallas, Texas, which is the home to tons of investors, family offices, investors of all kinds, a campus full of them. Old Parkland here in Dallas, Texas. Our web address is www.cypressgrowthcapital.com. And that's the best way to get a hold of me as well, is just my email, which is vshieh, VHSIEH, at cypressgrowthcapital.com. Love talking to new people all the time. So
Yeah.
truly, genuinely mean it. Just email me anytime or reach out to me on LinkedIn. And
Yeah.
love to
And I don't think we've done a deal together, but we will eventually, I'm sure. I think you're on my deal
sure we
flow
will,
list.
for sure.
Yeah. But yeah, this was great. Thank you so much for coming on the program. I'm sure founders and even VCs out there learned a ton from today. Thank you so much.
Thanks for your time today, Brian. Have a great afternoon.
All right. Thanks, Vince.